As we start 2024, we're very much in a time of transition as an economy, an industry, and a company. Our success is evident in our most profitable year to date, delivering 33% growth in adjusted EBITDA and free cash flow of $194 million in 2023. We also closed out 2023 with a strong selling season that yielded double-digit bookings growth over the prior year, as approximately 75% of our bookings were upsells or expansions with existing clients. This year, we will grow our adjusted EBITDA margins and free cash flow. We'll do this by both growing our revenue and removing more than $85 million in expenses through efficiencies and restructuring. We're targeting 50 to 100 basis points of annual margin expansion over the next 3 years and have line of sight to at least $425 million of adjusted EBITDA in 2025. This puts us in a strong financial position, and it provides us the flexibility to have all options on the table, including continued investments in organic innovation, tuck-in M&A, retiring debt, and giving back money to our investors through share repurchase. On the top line, our consolidated revenue grew 4% on a year-over-year basis in the fourth quarter. The integrated care segment delivered over 320 basis points of margin expansion and 42% growth in adjusted EBITDA for the full year. While we're pleased to deliver double-digit adjusted EBITDA growth at BetterHelp, both for the quarter and the full year, revenue and margins were below our expectations in the quarter, as we saw lower yields on marketing spend. Specifically, we experienced returns on our social media advertising spend that were below target in the second half of the year. Our BetterHelp outlook assumes the lower yields experienced in certain channels in the second half of 2023 will persist, and as a result, will impact our year-over-year growth rates in the first half of 2024. From a business model perspective, the beauty of our virtual care business is that it's a very stable asset. At the same time, it's important to remember that most U.S. healthcare consumers have access to virtual urgent care today. We've consistently taken share in this market, and we expect to continue to do so. But it's fairly well penetrated, and accordingly, we anticipate revenue growth from our U.S. virtual care products will be in the low single digits going forward. To date, we have identified actions that we expect will result in approximately $85 million in total annual run rate operating expense savings by the end of 2024.
We ended the year with over $1.1 billion in cash and cash equivalents on the balance sheet. We expect full year 2024 revenue to be in the range of $2.635 to $2.735 billion. We expect full year 2024 consolidated adjusted EBITDA to be in the range of $350 to $390 million, and margin for the BetterHelp segment of flat plus or minus 50 basis points.
Yeah, so I would say on your second question, Jailendra, most of the benefit of these cost efficiency and cost takeout programs is really on the integrated care side. As we said in our prepared remarks, the integrated care side is where we will see more of margin expansion as we go through the year. We can drive more operating expense leverage on the integrated care side of the house. The reality is, if you think about the way the margins we expect in 2024, the margins to play out, we are seeing some modest pressure on our gross margin line from higher clinical costs, and that's primarily associated with the expected ramping up in Primary360 volumes. And so that ramp will create some modest pressure on gross margins this year relative to 2023. If I think about the uses of cash, I would say, the way I would prioritize it is, as we said, first, what are the interesting M&A opportunities that are out there that we could use our balance sheet for? And then I would use our cash to pay down, to retire the debt. And then last is, as we said, opportunistically, strategically think about share buybacks. Share buybacks in general, and to think about over the longer term to offset the potential dilution from employee stock grants.
as we increase our ad spend, we're constantly looking at the marginal return, and to the degree that we see the curve get to an inflection where we run out of room on where we can spend that money productively, then we pull back rather than chasing growth at the expense of profitability.